People ask me the secret to never running out of money in retirement. They want a formula, a system, some magic number they can hit and then coast. I tell them, the secret is that you never spend the goose, you only eat the eggs. They look at me like I've lost my mind. They say, "What does that mean, Charlie?" I say it means this: the day you retire, your principal is no longer your money. It belongs to your children, your grandchildren, and the 35-year-old version of yourself who doesn't exist yet but will. You live on what the principal produces, not what it is. What it produces, forever. Most 60-year-olds get this backwards. They think retirement is permission to spend what they saved. It is not. Retirement is permission to live on what your savings generate. If you saved $800,000, you do not have $800,000 to spend. You have $24,000 to $32,000 annually to spend, and $800,000 that must remain intact until you die. I've watched people with $1.2 million retire at 62 and be broke. By 74, I've watched people with $600,000 retire at 65 and die at 91 with $900,000 still in the account. Same number of years, different rules. The difference isn't the market. It isn't luck. It is whether they understood what retirement money actually is. Hit the like button if you're ready to hear the rules that keep you from eating your own seed corn. I only share this with people serious about the long game. Before we get into this, drop a comment right now and tell me where you're watching from. City, state, country? I want to know who's in this room. Just let me know. Here is why intelligent people destroy their own retirement. Most people think retirement savings is a pile of money you slowly spend down until you die. And if the pile runs out before you do, you had a bad plan. That is nonsense. Retirement savings, properly structured, is a machine that produces income in perpetuity. Your job is to protect the machine, not cannibalize it. The truth is this: a 60-year-old who retires today has a reasonable chance of living to 88. That is 28 years of retirement. The 4% rule says you can withdraw 4% annually and not run out over a 30-year period. But 4% requires perfect discipline and average market returns. Miss either one and you fail. There is a better way. Never touch principal. Live on dividends, interest, and distributions only. Let the principal grow. Die with more than you started. That is not greed. That is engineering. I'll show you 4 simple rules that make this work. Rules anyone can understand, but most won't follow, because they require a specific kind of discipline that feels like deprivation, but is actually freedom. The first rule is the one everybody skips. Rule number 1, set your number before you retire, the income floor. Here is the first rule. Before you retire, calculate exactly how much income your portfolio produces annually. That number, not your portfolio balance, not your Social Security estimate, not your pension, is your retirement income. If that number does not cover your expenses, you do not retire yet. This sounds obvious. Nobody does it. The problem is, people think in balances, not income. They say, I have $850,000. That feels like enough. It does not matter what it feels like. What matters is what $850,000 produces. An $850,000 portfolio in dividend-paying stocks and bonds generating 3.2% annually produces $27,200 per year. Add Social Security of $24,000, and you have $51,200 annually. If you need $58,000 to live on, you cannot retire yet. This is arithmetic, not opinion. But people ignore the arithmetic because they want to retire, and the balance feels big enough. Here is the second problem. People count Social Security as guaranteed income and plan around it. Social Security is the floor, not the ceiling. It was designed to replace roughly 40% of pre-retirement income for average earners. If you earned $80,000 annually, Social Security replaces about $32,000. You need to produce the remaining income from your portfolio. That means your portfolio must generate $26,000, $30,000, or $40,000 annually, depending on your lifestyle. Before you retire, you must know this number precisely. The third problem is inflation blindness. Your expenses today are not your expenses in 15 years. At 3% annual inflation, what costs you $50,000 today costs $77,898 in 15 years. Your income floor must account for this. Dividend income from quality companies grows over time. This is the mechanism that protects you from inflation eating you alive. But you must own the right assets before you retire, not after. The time to restructure your portfolio toward income is 3 to 5 years before retirement, not the week you hand in your badge. The fourth problem is sequence of returns risk. Nobody talks about this plainly enough. If you retire into a bad market and you are already spending principal in year 1 or year 2, you may never recover. A 30% market drop in year 1 of retirement, combined with 4% annual withdrawal, leaves you with 66% of your starting balance, but now needing to withdraw a higher percentage to get the same dollar amount. The hole deepens every year. But if you are living on dividends only and the companies maintain their dividends, you simply ride through the downturn. Your income is unchanged. Your principal will recover. This is the structural advantage of income-only retirement over withdrawal-based retirement. One survives bad markets, the other is destroyed by them. Let me tell you about Gerald Okafor. Gerald was a civil engineer in Phoenix. He worked for a large construction firm for 34 years. At 62, he had $920,000 in his 401k, a $28,000 annual Social Security estimate, and a small pension of $14,000 annually from a previous employer. Total guaranteed income coming in $42,000 annually. He needed $68,000 to maintain his lifestyle. The gap was $26,000. He figured his $920,000 at 4% withdrawal would cover it. $920,000 times 4% is $36,800. $42,000 plus $36,800 equals $78,800. More than enough, he thought. He retired at 62. The first year was fine. The second year, his roof needed replacing. $18,000. He pulled from principal. Year 3, his wife needed knee surgery. $12,000 out of pocket. He pulled from principal. Year 5, the market dropped 24%, and his $920,000 was now $699,200. He was still withdrawing $36,800 annually, but now that was 5.26% of a smaller portfolio, accelerating depletion. Year 8, Gerald and his wife took the European trip they had always promised themselves, $14,000. Year 10, he helped his daughter with a down payment, $25,000. Each time, he told himself it was a one-time exception. By age 73, Gerald had $480,000. His 4% withdrawal from $480,000 was $19,200. Add Social Security and pension, $61,200. His expenses were $74,000. He was $12,800 short annually. At 75, Gerald went back to work as a part-time consultant. He earned $22,000. He is 78 now. He still works. He is not broke, but he is not retired. He will work until his body gives out. He had $920,000 and ran short because he never established an income floor before he retired, and he treated principal as a backup checking account. Here is the arithmetic. Gerald's $920,000 in a diversified dividend portfolio yielding 3.5% would have produced $32,200 annually. Add Social Security and pension, $74,200, exactly what he needed. If he had never touched the principal, market fluctuations would have reduced his income temporarily, but never his principal. By age 78, if the portfolio grew at 5% annually, while he withdrew only dividends, he would have $1,340,000 in principal, $420,000 more than he started with. He would have left his children a meaningful inheritance, which he had always hoped to do. Instead, he spent principal every year and is working at 78. The difference between Gerald and Margaret is not intelligence. Gerald was an engineer. He understood mathematics better than most people. The difference is that Gerald calculated his balance and assumed it was enough. Margaret calculated her income and made certain it was enough. One thought in balances, one thought in income streams. Only one retired successfully. At 60, you must think in income streams forever. The balance is irrelevant. What matters is what the balance produces annually, reliably, indefinitely. If you cannot answer that question precisely, you are not ready to retire. That is the income floor rule. Know it before you leave. She was a librarian in Vermont. She retired at 65 with $540,000 in retirement savings, a pension of $18,000 annually, and Social Security of $21,600, total guaranteed $39,600. Her annual expenses were $52,000. Her gap was $12,400. Before she retired, she restructured her $540,000 into dividend-paying stocks and bond funds, generating 3.8% annually, $20,520 per year. That covered her gap with $8,120 to spare. She retired. She spent only dividend income. She never sold a share. Margaret is 81 now. Her portfolio has grown to $812,000 because she never touched principal, and the dividends from quality companies grew over time. Her annual dividend income is now $30,856. She has more income at 81 than she had at 65. She has more principal at 81 than she had at 65. She drives a 12-year-old Honda, takes the train, and reads library books. She will die with more than she retired with, and she has not worried about money once in 16 years. The principle is this: know your income floor before you retire. If your portfolio income plus guaranteed income does not cover your expenses, you have three choices: work longer, reduce expenses, or both. Retirement without an income floor is gambling with your last stack of chips. Rule number 2, never touch principal. The goose rule. Here is the second rule. On the day you retire, your principal becomes permanent, untouchable, sacred. You live on what the portfolio produces. Period. Not what the portfolio is, what it produces. The day you dip into principal for a non-emergency expense, you have broken the goose. Every dollar of principal you spend is not just that dollar. It is every dollar that dollar would have produced for the rest of your life. Most people cannot grasp this. So, let me show you the arithmetic. The problem is that dipping into principal feels like nothing. You have $800,000 and you need $15,000 for a roof. You take $15,000. You still have $785,000. Feels fine. But that $15,000 at 5% annual growth over 20 years would have been $39,848. You did not spend $15,000. You spent $39,848. And if you spend $15,000 from principal twice a year for 20 years, you have not just spent $300,000. You have spent $797,600 in lost future value. You destroyed your portfolio from the inside while it looked healthy from the outside. I am going to say that again because most people do not feel it the first time. When you spend $15,000 of principal at age 65, you are not spending $15,000. You are spending $39,848 at age 85. Purchasing power. The $15,000 is just the visible part. The missing compounding is invisible until you are 82 and running out and wondering where it all went. Where it went is the answer to every question you did not ask when you were 65, pulling $15,000 for a roof that felt justified. Here's the second problem. Once you allow principal spending, you will never stop. Every spending decision becomes justified. The car breaks down, principal. The grandkids need help with college, principal. The vacation you deserve, principal. The medical bills, principal. There is always a reason. Once the rule breaks, it is broken forever. Let me tell you about Harold and Patricia Stern. Harold was a pharmacist in Cincinnati, retired at 64 with $1,100,000 in retirement savings. Patricia retired at 62. Combined Social Security, $38,000 annually. Harold's pension, $22,000 annually. Total guaranteed, $60,000. Their expenses, $72,000. Portfolio gap, $12,000. Their $1,100,000 portfolio was generating 2.9% in dividends, $31,900 annually. That more than covered the gap. On paper, they were fine. They would never touch principal. That was the rule. Year 1. Harold's brother in Florida was dying. They flew down 4 times, stayed at hotels, paid for medical equipment Harold's brother could not afford, spent $22,000 from principal. Exceptional circumstances. Of course they did it. Nobody blames them. Year 2. Their granddaughter got accepted to a private university. They helped with $18,000. Just once, they said. It was family. Year 3. Patricia decided she wanted to renovate the kitchen. They had talked about it for 20 years. $31,000. They had the money. Year 4. The market dropped 19%. Their $1,013,000 became $820,530. Harold panicked. He moved 40% to cash. When the market recovered 14 months later, he was only partially back in. He had missed the recovery. His portfolio was now $871,000. By year 6, their portfolio was $788,000. They were generating $22,852 in dividends. The gap between their income and expenses had widened from $12,000 to $21,148. They started withdrawing from principal regularly just to cover basic expenses. The spiral had begun. Harold is 74 now. Patricia is 72. They have $490,000. At their current depletion rate, they run out at 82. Harold knows this. He does not sleep well. He was a pharmacist, not a spendthrift. He made $94,000 a year for 30 years. He did everything right until he retired. Then he made exception after exception until the exceptions became the rule. Here is the arithmetic. Harold and Patricia's $1,100,000 generating 2.9% dividends produces $31,900 annually. Add guaranteed income, $91,900 annually. Their expenses, $72,000. Annual surplus, $19,900. If they never touch principal and reinvest the surplus, in 20 years, their portfolio is worth $2,910,000 and generating $84,390 in annual dividends. They cannot spend it fast enough, but they spent principal, 6 years of principal withdrawals plus the market timing mistake left them with $490,000 generating $14,210 annually. Add guaranteed income, $74,210. Their expenses, $72,000. Surplus, $2,210 annually. No cushion, no margin, no security. One hospital stay, one major repair, one market correction, and they are negative. The cushion is gone. Harold spent his cushion on airport hotels, kitchen cabinets, and college tuition. All of it justified. None of it affordable in hindsight. Barbara Nwosu did it right. She was a middle school principal in Houston who retired at 66 with $670,000 in a diversified portfolio. Social Security, $26,400. Small pension, $9,600. Total guaranteed, $36,000. Portfolio yield, 3.6%, $24,120 annually. Total income, $60,120. Expenses, $54,000. Surplus, $6,120. Barbara wrote the rule on a piece of paper and taped it to her refrigerator. The principal is not mine. It belongs to the future. When her son needed $8,000 for car repairs, she said no. She said, "I cannot give you what is not mine." Her son was angry. He got over it. When her bathroom needed remodeling, she waited 2 years and paid for it from the surplus in her income account, not from principal. She never broke the rule once. At 79, Barbara has $1,140,000. Her dividend income has grown to $41,040 annually. She has more money than she started with. She is not worried. Her son calls her every Sunday. The goose rule is simple. Never kill the goose. Live on eggs, only eggs, always eggs. But even perfect discipline around principle is useless if you hold the wrong assets. Rule number 3, own the right assets. Income over appreciation. Here is the third rule. At 60, you're no longer investing for growth. You're investing for income. These are not the same thing. The asset that doubles in price but pays no dividend is useless to a retiree who needs income. The asset that pays 4% annually and grows at 3% per year is the engine your retirement runs on. Most 60-year-olds are holding the wrong assets because their financial advisor is still managing them like they are 40. The problem is that growth assets and income assets require different behavior from the owner. Growth assets require patience and long holding periods. You buy Apple at $50 and hold it until it is $180. Income assets require consistency. You buy a dividend ETF and it pays you quarterly forever. Retirees mix these up. They hold growth stocks because they cannot bear to sell them, but they need income now, not capital gain someday. So they sell shares to generate income, which is principal destruction dressed up as income. You're not generating income. You're consuming the herd one animal at a time and calling it a harvest. Here is the second problem. Advisors put retirees in bond-heavy portfolios because bonds are considered safe. This is backward at 60. A 60-year-old retiring today has a 25 to 30-year investment horizon. Over 30 years, bonds will not protect you from inflation. At 3% annual inflation, a bond paying 4% produces a real return of roughly 1% annually, barely treading water. Meanwhile, a company that raises its dividend by 6% annually is growing your income stream faster than inflation every single year. In 12 years, that company has doubled your dividend income. Your bond is still paying the same dollar amount while the purchasing power of that dollar has shrunk by 30%. Dividend growers are the only inflation-proof income machine that most ordinary investors can access. That is the point. Not yield, not income today. Income growth over time. A 2.8% yield from a company that grows dividends 7% annually is worth more than a 5.2% yield from a company that never raises its dividend. In 10 years, the 2.8% becomes 5.5% on your original investment. In 20 years, it becomes 10.8%. You did not do anything. The company compounded for you while you slept. The right portfolio for a 60-year-old who will live to 88 is approximately 60 to 70% dividend-paying equities, 20 to 30% bonds for stability, and 5 to 10% cash for emergencies. The dividend equities must include companies with 20-plus year track records of dividend increases, not just dividend payers. Dividend growers, there is a profound difference. Let me tell you about Vincent Caruso. Vincent retired at 63 from a manufacturing company in Pittsburgh with $780,000. He handed his money to an advisor who put him in a conservative portfolio. 40% stocks, 50% bonds, 10% cash. The bonds yielded 3.1%. The stocks in the portfolio were growth-oriented, minimal dividends. The whole portfolio generated about 2.1% in income annually. At 3.1% expenses and 2.1% income, Vincent needed to sell assets for income. Every year, he sold $7,800 in assets to cover expenses. When the market was up, this felt painless. When the market was down 18% in 2022, Vincent was forced to sell shares at reduced prices to generate income. He was selling low and not buying, the opposite of what builds wealth. His advisor called this systematic withdrawal. I call it slow, bleeding. At 72, Vincent has $594,000. His income from the portfolio is $12,474. Social Security, $28,800. Total, $41,274. His expenses are $56,000. He is selling $14,726 annually now. At this rate, he runs out at 81. His advisor is still charging 1% AUM annually. That is $5,940 this year on a shrinking portfolio. Here is the arithmetic. Vincent's $780,000 in a dividend growth portfolio, 60% equities yielding 3.8%, 30% bonds yielding 3.2%, 10% cash, would generate approximately $27,300 annually. Add Social Security, $56,100 total. Covers his $56,000 expenses with a $100 surplus. No selling, no depletion. At 8% average equity growth over 9 years, his dividend income has grown to $36,000. His portfolio has grown to $910,000. He has more money at 72 than he had at 63. Instead, he is at $594,000 and declining, not because of markets, because of asset allocation, because his advisor did not understand that a retiree needs income, not appreciation. Dorothy Huang was a dental hygienist in Sacramento who retired at 65 with $520,000. She had read enough to know she needed income, not growth. She put $364,000, 70%, into dividend growth stocks. Johnson & Johnson, Procter & Gamble, Realty Income, Coca-Cola, companies that had raised dividends for 25 or more consecutive years. She put $130,000 in bond funds. She kept $26,000 in cash. Her portfolio generated $18,720 annually in dividends. Social Security, $22,800. Total income, $41,520. Expenses, $38,000. Surplus, $3,520 annually, which she reinvested. At 78, Dorothy's dividend income has grown to $29,040 because the companies raise their dividends every year. Her portfolio has grown to $794,000 because she reinvested the surplus and never touched principal. She has more income at 78 than she could spend. She has more principal than she started with. The right assets do the work, so you do not have to. Dividend growers are the engine. Once you own them, your only job is to leave them alone. Which brings us to the rule that kills more retirees than anything else. Rule number 4. Ignore the noise, the price. You pay for panicking. Here is the 4th rule. On the day you retire, cancel your financial news subscriptions. Delete the stock apps. Stop watching CNBC. Stop reading the Wall Street Journal. The financial media exists to create anxiety so you will act. Action destroys retirement accounts. Inaction preserves them. Every time you react to a headline and change your portfolio, you cost yourself years of income. The problem is that retirees cannot tolerate volatility the way young people can. A 35-year-old can watch their portfolio drop 30% and say, "Good, I'll buy more." A 65-year-old watches their portfolio drop 30% and thinks, "I'm going to run out of money." One person is correct. The other is panicking. The panic is understandable. It is also expensive. Every panic sell costs you not just the loss you realize, but the recovery you miss. And markets always recover. The pattern does not change. The calendar changes. The names of the panickers change. The math stays the same. Here is the second problem. The financial media is not your friend. They make money on clicks and attention. Fear generates more clicks than calm. Dividend stocks will quietly make you wealthy. Over 30 years generates no traffic. Is your retirement at risk? What you need to know now generates millions of clicks. Every time you click that headline and act on it, you interrupt compounding, pay transaction costs, and often generate a taxable event. You enrich your broker, enrich the government, and impoverish your portfolio. The media makes money. Your advisor makes money. You lose. The third problem is that financial media creates the illusion of urgency. Every week, there is a new crisis: inflation, recession fears, geopolitical tension, banking stress. These crises are real. They are also noise to a retiree holding dividend-growing companies. Johnson & Johnson paid its dividend through the 1987 crash, through the dot-com bust, through 2008, through COVID, through every crisis in the last 60 years. The dividend arrives, the crisis passes. The retiree who did nothing had their income interrupted for 0 quarters. The retiree who panicked and sold locked in losses and missed the recovery. Let me tell you about Frank and Miriam Johansson. They retired in Scottsdale at 65 and 63 respectively, with $1,050,000 in a dividend growth portfolio. Social Security, $46,000 combined. Dividend income, $36,750. Total, $82,750. Expenses, $74,000. They were fine, more than fine. Then came a market correction, not even a crash, a 22% correction over 6 months. Frank watched every day. He tracked the decline. $1,050,000 became $819,000. He watched $231,000 disappear on paper. His dividend checks still arrived. The companies he owned still operated. But the number on the screen fell every week, and Frank could not sleep. At month 4 of the correction, Frank called his advisor and said, "We need to move to cash." The advisor said, "Your dividends haven't been cut. Your companies are fine. This will recover." Frank moved to cash anyway. He sold $630,000 worth of positions at a 22% loss and parked it in a money market at 0.1%. The market recovered fully 14 months later. By then, Frank had missed $126,000 in recovery gains on the $630,000 he had sold. He re-entered the market piecemeal over 18 months because he was afraid of another drop. He never fully recovered his position or his dividend income. At 75, Frank and Miriam have $826,000. Their dividend income has stagnated at $24,780 because they own fewer shares than they should. Total income, $70,780. Expenses, $74,000. They are $3,220 short annually. They are dipping into principal. The slide has started. Frank told me he had watched $231,000 disappear, and he could not sleep. I told him the truth. He did not lose $231,000. He lost $126,000 in recovery gains, plus another $200,000 in future dividend income because he panicked and sold. He turned a paper loss into a real loss. The market recovered. His portfolio did not because he wasn't in it when the recovery happened. Here is the arithmetic. If Frank and Miriam had done nothing during the 22% correction, their $1,050,000 would have recovered to $1,050,000 14 months later and continued growing. At 75, without touching a position, they would have $1,420,000 and generating $51,120 in dividend income annually. They would have more income than they can spend. Instead, panic cost them $594,000 in portfolio value and $26,340 in annual dividend income. Frank slept badly for 4 months during the correction. He will sleep badly for the remaining years of his life because of the decision he made during those 4 months. Eleanor Riggins was a retired teacher in Portland with $490,000 in dividend stocks when the 2008 crash hit. Her portfolio dropped to $318,500 at the bottom, a 35% decline. Her dividend income dropped from $17,150 to $11,148 because a few companies cut dividends. She did not sell a single share. I had nowhere to go with the money, she told me. Savings accounts were paying nothing, and I thought about what my father told me. The dividends will come back faster than you think. So I sat. The dividends came back. The portfolio recovered. By 2012, Eleanor had $541,000 and $19,110 in annual dividend income. By 2016, $724,000 and $26,100 in income. She watched $171,500 disappear on paper in 2008 and did nothing. That discipline made her rich. The principle is this: volatility is not loss. Loss is selling during volatility. If your dividends arrive, your companies are operating, and you do not sell, you have not lost anything. The price is just a number that fluctuates. The dividend is real money that compounds. Protect the dividend. Ignore the price. That is the entire strategy. I learned this from my grandfather, Amos Ingham. He was a school teacher in rural Nebraska who retired in 1961 with $48,000 in savings, a fortune in those days for a man of his income. He was not a sophisticated investor. He did not know what a P/E ratio was. He did not understand options or margin or bond duration. He understood one thing, that his savings was a herd of cattle, and a man with a herd of cattle does not eat his cattle. He breeds them and eats the calves. He said, "Charlie, a man who spends his principal is a man who is eating his cattle. You can eat them once, or you can breed them and eat their calves forever. The cattle are not yours to eat. They are your herd." Grandpa Ingham kept his $48,000 in dividend-paying utility stocks and never sold a share. He lived on dividends plus his pension. When he died in 1987 at age 83, he had $340,000 in that account, and the dividends were paying him $17,000 annually, more than 3 times his pension. He never earned more than $35,000 in any year of his life. He had $340,000 when he died because he followed one rule for 26 years of retirement. The high principle is the herd. You live on calves. You never slaughter the cattle. My mother told me this story whenever I talked about spending something I shouldn't. Don't eat the cattle, Charlie. I have heard that sentence in my head for 70 years. It is the simplest financial truth I know. Let me make this simple. Here are the rules. Rule 1. Know your income floor. Calculate what your portfolio produces annually before you retire. If it doesn't cover your expenses, you're not done working yet. That is physics. Rule 2. Never touch principal. The day you retire, your principal belongs to the future. Live on eggs. Never kill the goose. The snowball only grows if you leave it alone. Rule 3. Own the right assets. Dividend growers, not growth stocks. Income that grows faster than inflation, not price appreciation that requires selling to convert to cash. Wrong assets kill discipline. Rule 4. Ignore the noise. Volatility is not loss. Selling during volatility is loss. Cancel the financial news. Sit on your ass. The waiting is the strategy. These are not complicated rules. Almost nobody follows them because they are not easy. They require you to watch your portfolio drop 30% and do nothing. They require you to say no to your grandchildren and your kitchen renovation and your European vacation because the money is not yours to spend. That level of discipline is rare, but the people who have it retire with more than they started with. Everyone else runs out. Here is your challenge. Open your retirement account today. Calculate the annual income it produces, dividends, interest, distributions. Write that number down. Now calculate your annual expenses. If the income does not cover expenses, you know what you need to do before you retire. Work longer, cut expenses, or restructure your assets toward income. If you are already retired and you are spending principal, stop. Every dollar of principal you preserve today is multiple dollars of income you protect forever. It is not too late to stop the bleeding, but it requires deciding today that the principal is off limits, not mostly off limits, completely off limits. I am 99 years old. I have watched this movie play out thousands of times. The ending is always the same. The people who protect principal die with money. The people who eat principal die broke or working. There is no third outcome. Arithmetic does not offer a third outcome. I won't be here much longer to tell you this, but the rule doesn't need me to be here. The rule is permanent. Never eat the cattle. Protect the herd. Live on calves forever. Set your income floor. Protect the principal. Own dividend growers. Ignore the noise. That is it. Follow those 4 rules and you will die with more than you retired with. Ignore them and you will run out. And running out of money at 78 is a specific kind of misery I do not wish on anyone. Your choice. Make it today. The arithmetic is not waiting for you to feel ready. Write these 4 rules on a piece of paper. Put it somewhere you will see it every morning. Read it on the days you are tempted to move to cash, spend from principal, or react to a headline. Read it on the days you want to help someone with money you don't have to give. Read it on the days the market drops and fear tells you to do something. The rule is the same every day. Protect the herd, live on calves, own the right animals, ignore the weather. That is all of it. That is the entire formula for a retirement that lasts as long as you do. Now, if you want more brutal honesty about retirement and wealth, timeless principles that actually work instead of get-rich-quick garbage, subscribe to this channel. We don't promise easy. We don't promise fast. We promise truth.